So this is going to talk about the financial reporting and analysis. That's the what they call it in the curriculum, the accounting material, and it is a significant portion of the exam. It has a heavy weighting, and there's a range there, and now, a lot of people do find it tricky. It seems to be the swing. I'm talking about financial reporting and analysis. A lot of people, even if you have a strong accounting background, find it kind of tricky. So what I want to do, here is integrate, there is a question or two about some concepts sent to me, integrate it in terms of a way that I want you to approach this material to go through it. Okay. So that you can then, you can then practice what I call, the right way to study, the CFA way to study. Okay. Now, this is a series of just knowledge items, what I call knowledge items. And with the accounting material, it is framed by the income statement. So I'm just going to write out a really basic income statement here. I'll start off with revenue. So I could write revenue or sales. It means the same thing. I can take off the cost of goods sold, and I'll work through these in a minute. Let me just write them down. That's going to give me my gross profit, GP. From here, I'll take off my expenses, my operating expenses. I'll take off my depreciation, and this is going to get me down to my earnings before interest and taxes, my operating income. From here, I'll take off my interest expense. And then this will get me down to my earnings before tax, EBT. Then I'll take off my tax, and this will get me down to net income, okay, or earnings after tax. So this kind of frames the CFA curriculum. And what I mean by this is, and you'll notice as you start going through the material, we start off with revenue recognition methods. So percentage of completion versus completed contract. Okay, let me just list these out here. Okay, the installment method, installment sales, barter transactions. I'll write it over here, barter. Okay, so even questions about just recognizing revenue. When, under what circumstances do we recognize revenue? So I definitely think that you've got it, we'll drop through, we'll see how far we get here, but we'll talk about here, percentage of completion versus completed contract. You only need to know it to a certain level of depth, and don't run into that, feeling of saying you've got to master it, because you really, I think that will go way beyond the CFA exam, and you're going to get slowed, and you're never going to get through all the material. Okay, if this was an accounting course and we had 15 weeks on just accounting, then absolutely that's it. You're going to want to make sure you dive deeper. But here, you just want to stay close to what I've outlined in the notes, and then get into exercises so that you can then become familiar with the way it's going to be tested. That's the unfortunate part about the CFA exam. That's the way it goes. And same for installment method, barter transactions, gross or net reporting. I mean, all these concepts are related there. So you can see they're framed here. Let me drop down here to COGS. Okay, COGS, cost of goods sold. It's going to be related to our inventory. And this is where, again, we're going to have questions about the inventory methods, LIFO, FIFO, the perpetual versus periodic. I kind of was mixed on this in terms of, whether it shows up on the exam, and then I created an example because one of my students said, you better do that. There's the connection here. And what goes on the balance sheet under the inventory account, and what is a period cost that shows up on our income statements. This is the connection here. This is not an accounting course. The question is, do we start talking about returns and allowances? Not really, okay? Not really, okay? And you're not getting into, let's say, sales and then taking off returns and allowances, okay? So I don't think that we're going down that far, okay? So there are some like I said, concepts that I've nailed for you. So that's what you really want to stick to, okay? All right, so dropping down a little further, down here at expensing. So the CFA curriculum, type of questions, will be expensing, which means, put it on the income statement and subtract it, versus capitalizing. And capitalizing means put it on the balance sheet and slowly depreciate or amortize. So remember, we are an investment analyst. We are not an accountant. So we are interpreting management's choice. If one company decides to expense an item, how does that play out in terms of the operating income, the pre-tax income, the taxes, the net income? If another company capitalizes, what are the effects? That's the way I think the questions are going. Okay, so that's what we need to keep in mind. Depreciation. Well, I think it's unlikely that you're just going to get a straight up calculate a depreciation question. But again, we need to know the effects and the differences between, let's say, a straight line depreciation versus an accelerated depreciation. And again, what does this accounting choice affect? And how does it affect the operating income, the pre-tax income, the taxes, the net income? Capitalizing versus expensing could also drop in down here for interest expense. Okay, and the highlight of the difference between IFRS and US GAAP for capitalization of interest. I think that could be an oddball kind of question. And deferred taxes down here, DT, okay, so the issues there. So what you can see is this income statement, I think, is a pretty good framework for the concepts that follow in the curriculum. So keep this in mind as your guide. Keep thinking about you are the user of the financial statements. You are not the creator. The creator of the financial statements is the accountant. We need to know how to interpret these kinds of choices. What if they use LIFO or FIFO? What does that affect? And by the way, another reason why I want you to think about it in terms of this income statement is the choices at whatever stage, let's say inventory, LIFO versus FIFO, the effects flow downwards. And I hope you can see this question. What I mean the effects flow downwards is, if I'm talking about right here, LIFO, FIFO decision, there's no effect up here on revenues. So it will affect the cost of goods sold. It'll affect the gross profit. It'll affect the operating profit. It'll affect the pre-tax profit, and so on. So you can see it flows downwards. If my choice, if we're talking about capitalizing versus expensing, there's no effect on revenues. There's no effect on gross profits. Oh, there's an effect on the operating profit, the pre-tax profit, the taxes. So you can see it flows downwards. That's the way, I want you to be able to think about this, okay? So this is the first concept, just thinking about how this income statement frames the concepts, the knowledge items that are coming. Okay. Now let me erase this, okay? And I got to draw it again because I've got another concept which comes from this income statement. So we've got revenue minus COGS. That's equal to gross profit. Take off the depreciation. Okay, I'll write it this way. It doesn't matter. Take off the expenses. Okay, I could have put EBITDA up there if I wanted to. Okay, this gives me EBIT, operating income. Take off the interest. Gives me the earnings before tax. Take off the tax. Gives me my net income. Okay, so now here's what we can use this for to help us. the concept of return on equity, ROE. So return on equity is, in its most basic form, the net income over the equity. And this is, let's say well, it doesn't, I don't think we have to separate, but it's the common equity, okay? Return on common equity. So that's right down here at the bottom line where net income is. Net income over equity. All right, well, we need to separate this and open this up so that we can understand as an analyst what is driving the return on equity. The general conclusion that a higher return on your equity is better, okay, that's fine, but what is causing this? So we can now come to the income statement, and this is how I frame it. So if we're talking about net income, so we're all the way down here. This is a three-stage decomposition. Net income over the revenue, or net income over the sales. That is referred to as my profit margin. I'll write underneath it profit margin. Multiplied by the revenue or the sales over my assets. This is my asset turnover. Okay, we'll just write a little multiplication sign in there. Times my assets over my equity. This is my financial leverage. So I've got a three-stage decomposition here for return on equity. And what I can do now as an analyst is say, what is responsible for the increase or the result for return on equity? Is it rising profit margins? That's a good sign. I like to see that. Is it improved utilization or efficiency in terms of my assets? I like to see that. Or is it simply just an increase in the financial leverage? Are they just using the leverage as a magnifier? This is the warning signal, okay? You know, that's not sustainable. So we've got a three-stage DuPont decomposition for ROE. And so this is how I remember it. And now, starting with this income statement, and by the way, by writing it out here, all of these three components have to simplify down to net income over equity. So I know if I get it right, the revenues cancel out, the assets cancel out, and I'm left with net income over equity. Okay, so that's an easy one there. Let's get rid of these lines. And now let's play around with this again. So I think that what CFA Institute's going to do is play around with this concept by grouping some of these terms together. And a very common grouping of these terms, okay, I'll get another color here. I hope we can see this, is to group the first two. So if I group these first two together, what does that mean? Well, let's just clear this off to give ourselves a little bit of room. So if I group those together, well, just remember the revenues cancel out and it leaves me with net income over the assets. Net income over the assets is known as return on assets. So ROE, I'll write it here, ROE, return on equity, is equal to the return on assets times the financial leverage. And now I'm finally going to get to the question that was asked and sent in here. So the question was the difference between return on asset and return on equity, and they were talking about a firm which has no debt. No debt. So if there's no debt, then this is the CFA signal that there's no financial leverage. Okay, the assets are equal to the equity. So assets over equity is equal to 1. Do not write 0. That's a common mistake. It doesn't mean it's 0. It means it's equal to 1. So what is the conclusion then? The conclusion then is a firm with no debt, the return on assets is the same as the return on equity. So there it is. And as you add debt, the return on equity moves away or increases beyond the return on assets. Okay, so there it is. That was cracking the code from that question. Okay, now there's another concept that I'm just going to add in here. Okay, that wasn't part of the question, but let's just see. Okay, let's hope I can erase all this and keep most of it up here. Okay, so it didn't have to do with no debt or anything like that, so we can get rid of these items here. And now let's even get rid of this bracket here. It was grouping the material, and let's just get rid of, let's hope I can get rid of this without erasing anything. There we go. Okay, all right, what a good system. And so now this one I'm just going to add is, what if we grouped the terms this way? Okay, a little bit less common, but what if we were to combine the terms? Well, the assets cancel out, and now what we're left with is the return on equity is equal to, and we know what this is, net income over revenue, that's the profit margin. And now we have the revenue over the equity. This is referred to as the equity turnover. Equity turnover. Okay, I'll put a bracket around it. Okay, there it is. So we know what the asset turnover is, revenue over assets, that's a turnover. So when revenue is over some accounting term, it's generally referred to as a turnover. So the equity turnover, I think you should know this. Okay, so just in case you're on the exam and they don't give you all of the accounts to work from, net income, revenue, assets, and equity, they may give you pieces of information. And one of the tricks is to know how to interpret this, equity turnover. Okay, so there we go. Hey, you guys okay on that? Okay. Okay, now the next thing then, let me just help you here, because the other potential question is a 5-stage DuPont decomposition, and you would need to know this. You would need to know this only if they asked for individual components. So a lot of people ask me, okay, how do I remember this return on equity 5-stage? Okay, so I always start down here, that net income. We were starting with the net income down here. That was the 3-stage. So that was, this was the net income over the revenues times the revenues over the assets times the assets over the equity. That's 3-stage. So now here's my little remembering tool here, looking at this income statement. If I now move up one layer on this income statement to go here to earnings before tax, to remove the tax burden, what happens to my equation now? Okay, well, now what I do is I'm going to write in blue the new terms. I'm starting with earnings before tax, EBT, over revenue. This is my pre-tax margin. Okay, and let's put in the revenues over the assets. The asset turnover, that hasn't changed. The assets over equity, the financial leverage, that has not changed. I now need to include something for the tax burden. And the tax burden now is going to be the net income over the earnings before tax. Okay, how do I remember this? Remember, it all has to cancel down to net income over equity. So I can see this canceling here. I can see the revenue canceling. I can see the assets canceling. I could see the earnings before tax canceling, and this is leaving me with net income over equity. Okay, but nobody does a 4-stage, so we're not going to stop at a 4-stage. But now what we're going to do is we're going to go up one more layer on this income statement here, and we're going to jump up here. We're going to jump up before the interest expense. So now we're going to, eliminate that capital structure difference, and let's fill this in. So now what we're looking at here is the, well, I'll write it here. Let's hope we can see this here. Let's write it in green. I'll have to put it here. Earnings before interest and tax over revenues or over sales. That's my operating margin. Okay, there's my operating margin. The revenue over the assets, and the assets over the equity, the turnover and the financial leverage, those have stayed the same. Let's see, I'm going to throw in my net income over my earnings before tax. That's my tax burden. And now what I need to add in here is the interest burden. And the interest burden is going to be the earnings before tax over the earnings before interest and tax. So now I'm at the 5-stage DuPont decomposition, and you would only need this if they asked you a specific question. Okay, remember, it all cancels down to net income over equity. Okay, I'm not going to do that here because I want to use the space, so I'm just going to erase this up here. Okay, and the way that I remembered this was by looking at the income statement, and that's I just walked up the income statement step by step. That's how I got here. And now they'd have to give you a specific question. This here is my op margin, OPM, operating profit margin. Okay, we know what the sales or the revenue over the assets is. This is the asset turnover, AT. The assets over equity, we know exactly what that is, financial leverage. The net income over the earnings before tax, this is the tax burden, TB. And then the earnings before tax over the operating income, this is my interest burden, IB. So they would have to ask you to calculate these individually, okay? Otherwise, you could just drop right down to net income over equity and you've got your answer, okay? One final comment about this is I think you've got to be ready. What type of question do I see coming? I see them asking you a question about the tax burden or the interest burden. And why do I see those as the questions? Because when you look at the change in these numbers, it's actually indicating the opposite effect. What do I mean by that? What I mean by that is if you see these numbers going up, it means the tax burden's gone down or the interest burden's gone down. Okay, take a look at one of my examples and you'll see that, okay? So I think that this is something just to be aware of. All right, you guys okay with that? So, okay, so let's just go right back to a basic concept that I think we must be aware of, okay? So accountants divide up the life of a business into time periods. And they do that so that they can measure what the performance is. Okay, so each of these time periods, we can look and we can see what's the revenue and what are the expenses, and we can figure out what the net income is for each of these periods. And then I can look at the next period and I can go on and say, okay, what are the revenues? What are the expenses? And what's the net income for this second period? Okay, so we're trying to measure what occurred during those time periods. Now, there are transactions which may have effects over multiple periods. So here's where I think that the CFA curriculum, is going to kick in, and where our being the analyst is going to start to kick in. And what happens, if management makes decisions, and for example, let's say we have what's referred to as, let me just clear this off here. Let's clear this off. Let's say in this first period, time period one, we have a transaction which is referred to as a prepaid item. A prepaid item means I buy something and it gives me a benefit over multiple periods. Okay, so what happens? So I think that you're going to see this type of question. This is related to the accrual accounting, concepts. And I think that on the exam, it'll be something like, what if there's an error? What if they do this incorrectly? Then what happens? So I think we're going to have to handle prepaid items. We'll handle this in a minute here. Now, what if a customer pays you before you deliver the product or you've performed the service? Well, you've got an obligation to deliver the product or perform the service. This will be referred to as an unearned revenue, UR. So let's just look at these two, and then we'll look at the accrued expenses and accrued revenues separately, okay? So handling these two, a prepaid item. All right, this goes on my balance sheet right here at the end. It goes on as an asset. Okay, when do we make the balance sheet? We do it at the end of the time period. And so it's on my balance sheet as an asset. And then what happens? Okay, what happens here? Okay, well, I have to recognize during the time period, I've got to make certain adjustments and such. Okay, so what's going to happen here? Okay, let me move these lines, because I don't want these lines to give us, give away any, make anything look, misleading. So prepaid item goes on the balance sheet as an asset. And then what happens? At the end of each time period, I need to make an adjustment. And the adjustment is to reduce the asset. And this is to reflect using up part of the asset. And an accountant's way of noting using an asset is called an expense. So I record, I'll just put an arrow up for an expense, EXP. Okay, so I just want you to be aware of these adjustments. I think that this is where the questions are going to lie. Okay, so I'll handle that in a minute. Unearned revenue. A customer pays you in advance. Okay, so this unearned revenue account by itself, forget about the cash or anything like that. This is a liability on my balance sheet. And then as I perform the service or deliver the product, I start to earn this revenue. So the adjustment then is to reduce the liability and record, I'll put an arrow up for recording the revenue. Okay, so what you're seeing here is the adjustments, and I think this is where the questions are going to come from. So, just let's just look at this and just think about what the question's going to be. Okay, these adjustments affect the balance sheet, and over here, expenses and revenues, the income statement, IS. Okay, I hope you can see that. So here's what I want you to be aware of in looking for questions here. I don't just think that they're going to ask us, what these are. What's a prepaid item? What's an unearned revenue? But I think that they're going to come over to these adjustments and they're going to say something like, what if they do not make the adjustments? Okay, so let's just handle prepaid as an example. If they don't make the adjustment, now we have to get into the question language. Okay, so let me just clear this off so it's not even in our way here. Okay, I'm just going to clear this off. Okay, I don't want that in our way. I'm just talking about the prepaid item here. Okay, so my X's between these mean we failed to make the adjustment. So now in the CFA world, in your questions, what you're going to be looking for is overstated, I guess I should have, written that somewhere else. Okay, let's just undo that. Okay, here, let's just get rid of that. Let me write it on the side so that we can use it. Okay, again and again. So you're going to look for this language of overstated, and understated. So when you're going through questions, look for this language, because I think this is the way they start to describe the effects. So if management fails to make the adjustment, then we did not lower the assets. So the assets are overstated. That's what you're going to look for. And let's take that one step further to think about some ratios, okay? It's no surprise that they're going to have, how about sales over assets, the asset turnover. If the assets are overstated, I'll put a little arrow that they're too high, then the turnover ratio is too low. There's no effect on revenues here. So they could have a question that now I think springs into the effects on the assets or the effects on the ratio. That's what I think that they're going to do. Okay, so that's where I think they're going with this kind of question. Okay, so what about the expenses? If we fail to recognize the expenses, then what happens? The expenses are understated. Okay, so the expenses are understated. And if the expenses are understated, then by definition, the net income will be overstated. I'll write an arrow up to mean overstated. So now I can start thinking about things like, how about the net income over the sales or net income over revenue? The profit margin is overstated. So I think this is the way that I think that you need to think about these items. Don't get caught just with the accounting. You are the user of the financial statement. You're the analyst. You're trying to interpret management's choices and the effects on these reported ratios and accounts. And now you're trying to use these to judge, value. That's what our job is, okay? So that's the way I want you to think about these items, okay? I hope that's okay. You guys all right with that? Okay, let's see if I can erase this part quickly here and now flip over to, let's just talk about this unearned revenue, okay, and see what happens here. And, you're probably, I hope you're getting, let's say a different way of thinking about this already, okay? This is it, the CFA way of thinking here. So unearned revenue, we know this went on our balance sheet, it's a liability. And we remember the adjustments that we're making at the end of the time period. I'm going to reduce the liability and I'm going to record the revenues on my income statement. Okay, so my question then was to say, all right, what if we fail to make these adjustments? What happens? Okay, if we fail to make the adjustments, then the liabilities are overstated and the revenues are understated. Okay, and so now we can spring into these type of again, ratios to see where these relate to. Okay, so I'm trying to get your thinking to change from, don't just think about it from the accounting. Don't try to balance things. Don't try to do that. Okay, what you're focused in on is isolating the information that's being given, the choice, the information, and what's the result. And now when you're answering your CFA questions, you're thinking about what the most likely result is or what could occur. So you're matching these kind of in step like this. Okay, so the unearned revenue, I went kind of quick through that, but I think that this is, where I see the question coming from. Okay, they don't have room for, they don't have room for, a lot of questions. Okay, not if it was an accounting exam, they could test all of them. We don't know which one they're going to test, so we just have to be ready here. Let's quickly take this off and talk about the accruals. Okay, okay, well, I'll erase this overstated, understated. I can write that out. And so the accruals, okay, what I'm talking about for accruals are accrued revenues and accrued expenses. So, let's see here. I'm talking about, so this is, I'll call this number 3, accrued expense. So what does accrued mean? Accrued means to build up. So, for example, we may have issued a bond. When you issue a bond, it means you borrow. And, we may pay interest every 6 months. But what happens on our financial statements at the end of the time period? What type of adjustments? So these build up. Okay, there's no entry in the journal. I mean, okay, you want to go back? I used to teach accounting. Forget that. There's nothing showing up on the balance sheet. But at the end of the time period, there is an adjustment that we need to do. Okay, we need to recognize that we owe something. Okay, so there's going to be on the balance sheet a liability. This is a payable. Payable. Okay, so I'm just going to write blank payable. It could be interest payable. It could be rent payable. Okay, so salaries payable. Okay, so a payable. Payable, if you read that word payable, it means that we owe this money and we didn't make any payments during the time period. Now I'm using this as my time period. So this is an accountant's way of indicating that, yeah, you know what, it wouldn't be fair to put it all in one time period. We got to spread it out. Part of that expense built up during this period. Okay, so payable. And then on the income statement, what type of adjustment? Well, we've got to recognize that there is an expense. So we've got to increase the expenses. So the adjustments for an accrued expense would be to record the liability on the balance sheet. That would be a payable. And then to recognize the expense on the income statement. And we're trying to, remember, get a good picture. What's the income for this time period? Revenues minus expenses. Okay, that's the way what we're thinking. As an analyst or as a level 1 CFA candidate, we're looking for these items here. We're trying to think about what are the next effects in terms of overstated, understated. Okay, number 4, an accrued revenue. Well, let's say now we own a bond. We're holding a bond and we don't receive our interest for 6 months. So it wouldn't be fair to write all that interest income 6 months from now. It builds up over each time period. So during this time period, I need to reflect the accrual, the buildup of the interest. Okay, so someone's going to eventually give me some money. When someone owes me money, an accountant's way of noting that is a receivable. So it's an asset and it's a blank receivable. I'll just write REC, receivable. It could be interest receivable. It could be salary receivable, rent receivable, any receivable. Okay, so a receivable. And now I need to recognize the revenue. So on the income statement, I recognize the revenue. Okay, there it is. My arrow up means recognizing. So these are the adjustments. And remember, we're in this time period. We want to get the revenues and the expenses so that we can figure out what that net income is, what occurred during this time period. How do we measure the performance? Okay, so this is the accruals, and there's 4 of them there. I don't know which one they're going to drop on the exam, but I think there's definitely going to be a question that relates to this concept, and you've got to know about these adjustments, and then you've got to be able to even take it one step further to being able to know about the consequences of those decisions. Okay, what if you fail to make those adjustments? That's really what I think you need to be aware of. Okay, You guys okay with that? Everybody's so silent here. Okay. Talking about the statement of cash flows here, adding up these categories to give us total cash flow. Another term that could mean total cash flow, they could just say change in the cash or change in the cash flow. Those two terms mean the same thing, okay, on our CFA exam. Now, let me just fill this in really quickly here, okay? For cash flow from financing, this is related to anything which changes the debt or changes in your equity. So the issue, the repurchase of debt and equity. And I'm just going to mention it here. Under US GAAP, it would be the dividends paid, the cash dividends. That's under US GAAP. Okay, so, but what I just want you to say is under cash flow from financing, this is the issue and the repurchase of debt and equity. And, you know, under US GAAP, it's the payment of dividends. I don't necessarily think you're going to be focused there. It's too easy. Okay, the cash flow from investing activities, I just want you to think about this as the investing in your business, capital projects. Okay, this is the purchase and the sale of the fixed assets. So I just want you to think about the change in the fixed assets, FA. Okay, purchase and sale of the fixed assets. Another term for fixed assets is property, plant, and equipment, PP&E. Okay, so the change in the property, plant, and equipment, that would come under investing cash flows. And a concept that you'll link for the next level, you know, if there was any investments, intercorporate investments, purchase and sale of let's say debt or equity of you know, affiliate firms, that would come under cash flow from investing. So I think that's a little beyond our level here. Okay, so change in the fixed assets. All right, there it is. Everything else, all the other transactions would be categorized as operating cash flow. Okay, so let's now focus in on this. Okay, so like I said, you know, if you were given the cash flow from investing activities and the cash flow from financing activities and the total cash flow or the change in cash, and by the way, another way of looking at that change in cash is on your balance sheet. The cash at the beginning of the year, and on your balance sheet, the cash at the end of the year. If they gave us the balance sheet information, I could calculate the change in cash. If they gave you those, then you could just find cash flow from operations by subtraction. Okay, don't be the hero going through step by step. Just take the easy way. Remember, it's just multiple choice. Okay, I don't think they're doing that. I think now, let's just clear this off. I think that now what we're going to have to do is calculate the cash flow from operations, and we're going to need to be able to handle this using what's referred to as the direct and indirect method. So direct, and then the indirect. Okay, let's hope that I left enough space here and they work out. Okay, so first of all, no matter which of these methods, direct or indirect, that you use, they should give you the same answer. Okay, so that's the first thing. Now, knowing, you know, that the direct methods used by corporate insiders who have access to purchase orders, and forget all that. Okay, that's an accounting course. Let's just dive right into it. The direct method, okay, here's what I want you to take away. So you're going to start off with what's referred to as the cash collections from customers. From the cash collections from customers, you're going to subtract cash payments to suppliers. And then you're going to also subtract all the other cash expenses. Cash, that says cash EXP. Cash rent, cash salaries, cash expenses. Okay, and this is going to get you right down to cash flow from operations. Okay, so now let me just give the big picture here, okay, and then we'll back it up, okay? If you're using the indirect method, you're going to start with the net income. You're going to add back your depreciation. Okay, this could be depreciation, amortization, anything that's a non-cash charge. Then you're going to make adjustments for your changes in your working capital, your current assets and current liabilities. Okay, so you are going to add a decrease in a current asset, except for cash. We're eliminating cash. So if the accounts receivable goes down, that means you collected some cash. Okay, you're also gonna add any increases in current liabilities, except for notes payable, which are debt. So if the accounts payable goes up, that's a source of cash. All right, you're going to subtract off an increase in current assets. So if your inventory goes up or your accounts receivable goes up, that is a use of your funds. That ties up your money, reduces your cash. If your current liabilities go down, if you've paid off some of your accounts payable, that's an outflow. That's a use of your cash. Again, that decreases your cash flow from operations. Okay, then there's some other unusual items here, and I'm just going to write them in here. Plus any losses. So if these are losses on the sale of assets, minus any gains on the sale of assets. Kind of looks backwards. Watch out for that. But we're not in the business of buying and selling our assets. That's something which is not part of our normal operations, our cash flow from operations. That's why I'm removing gains and putting back losses. Okay, I doubt you're going to get into the equity income from affiliates and such. So I'm just going to stop here. This will get you down to cash flow from operations. Okay, so remember, these should give you the same answers. Okay, we're almost there. We're almost there. Okay, so now what was asked here? Okay, so in the big picture, how do you know whether you're using the direct method or whether you're using the indirect method? You've got to pick up the signals from the question. If you see a language like cash payments, cash collections, cash expenses, that's a pretty good signal that you're using the direct method, okay? If you see items like net income and depreciation, okay, then these are signals for the indirect method. Okay, so that's top line. Okay, this is not an accounting exam, and I don't think they're giving you a full income statement and full balance sheet to work from. I think they're just going to give you a slice of accounts, and you're going to have to use those. Just use the information that's there. Okay, don't add in anything else. So you're going to have to quickly decide what you're using, direct or indirect method. Okay, so big signals we've already talked about. Now, cash collections from customers. What is this? This starts off with the sales. And now we need to make adjustments. We need to make adjustments for accounts receivable and unearned revenues. Okay, so let me just clear this off so that we can, I don't want to run out of space here. Okay, so I'm just going to make sure that we can read this here. So the sales are adjusted. So let's see here. Adjusted for accounts receivable and unearned revenues. So now let's just fill this in, okay? So let's see. I used to write plus and minus. I never liked that, okay? Because I never knew what to do. So I'm going to add a decrease in the accounts receivable. What does that mean? It means that I collected the cash. I'm going to subtract an increase in the accounts receivable. If accounts receivable increases, that tied up my money. This is where the plus or minus change in accounts receivable comes from. I'm going to add an increase in the unearned revenue. Someone paid me in advance. That's cash I've collected. I'm going to subtract a decrease in the unearned revenue. So what I'm putting together for you here is cracking the code where they say things like sales or revenue plus or minus change in accounts receivable, plus or minus change in unearned revenue. How do you use that? That's what's critical. Okay, so now we know how to use it, okay? All right, let's now switch over to the cash payments from suppliers. And, this requires an adjustment. Well, it starts with the COGS. So let's just write this in here. Cost of goods sold, COGS. And then it's adjusted for the inventory and the accounts payable. And now, this is the way that I do it, just so that I don't make any mistakes, okay? So you may come across practice questions where they're starting with positive numbers or negative numbers for this cost of goods sold. I just start with a positive number. This way, I'm going to do the math correctly, and I'm not going to add what I should subtract or subtract what I should add. And then I know at the end, I'm going to subtract my number. What does all this mean? Here's what it means, okay? Start with your cost of goods sold as a positive number. And now let's make the adjustment. If the inventory increases, we're going to add this. That was a cost. I bought more inventory. If the inventory goes down, then I am subtracting that. This is now freeing up some cash. Accounts payable. If the accounts payable has gone down, then I'm adding this. Why? That means that's using up my money. It's increasing the payment to suppliers. If the accounts payable goes up, this is freeing up some cash. So I'm reducing this cost of goods sold. So these adjustments, I keep it in mind here. Okay, just stay with me. I'm adjusting the cost of goods sold plus or minus for change in inventory, plus or minus change in accounts payable. Whatever number I get, I know that I'm subtracting that number from the cash collections. This way I don't have to worry about starting with a negative and then doing the opposite, okay? You're gonna know what I'm talking about if you're going through practice questions, okay? And then all I'm gonna do is subtract off other cash expenses and I can get myself down to cash flow from operations. Okay, so I'm just laying the foundation here. What I want you to do is jump in, go to CFA Institute questions and practice them. See what information they're giving you. Pick up the signals, direct and indirect. Okay, so which method are you using? First, recognize that. Then, I mean, this could be a standalone question right here. Calculate the cash collections from customers. This could be a standalone question. Calculate the cash payments to suppliers. Okay, I think you should know how to do those. Okay, and now calculating cash flow from operations, whether you're using direct or indirect. The one point that I didn't cover here that I'm going to just leave you with just in case is making the adjustment for payables and receivables. Okay, so I have been shown questions from students who said that there were adjustments made to, let's say, these cash expenses, or on the other side there were adjustments to some payables on the other side here for the indirect method. I have one of those in my notes. The example that I made up there, I used to teach in the old CGA program. I used to teach accounting there. Okay, I went through the program. I'm not an accountant. I never practiced, but I went through the CGA program. So that's where I started teaching that as well. So that's where my example comes from. But I just want you to be aware of that. Okay. So in this lesson here, we've covered a lot of points. I really want you to take away that the accounting, the financial reporting and analysis, it's not like learning accounting like you're an accountant. Think about that income statement, how that frames the accounting choices. Those are all of the knowledge items in the learning outcome statements. And then you're going through these one by one to say, can you handle these items? How many of these do you need to know to build up to get your marks on the exam? That's it. And you're just layering in the marks, adding them in. And that is a very powerful way to approach an exam like this, where there's so much content and then the exam is only a sampling of this curriculum. Okay, that's the way I think that you really need to approach this. So that's how you're building up marks, getting over the passing score. All right, that I think covers it there.